Welcome to the deep dive. We cut through the complex research, pull out the key insights, and hopefully find a few surprising facts along the way for you. Today, we're plunging into the thrilling, often wild world of cryptocurrency investing. Our mission here is to understand how cutting-edge AI is actually being used to navigate its legendary volatility. Specifically, we're going to unpack a really fascinating study. It compares two distinct automated investment strategies for crypto portfolios, and both are powered by this innovative approach called multi-agent systems.
Yeah, the crypto markets are quite the paradox, aren't they? I mean, they offer these incredible opportunities, huge growth potential. But as anyone who's dipped a toe in knows, they're also just a minefield, extreme volatility. And managing dynamic portfolios in that kind of environment it's incredibly challenging. What this study really hints at, I think, is how adaptive AI might offer maybe a surprisingly robust solution to that exact problem.
That's a really critical point. So let's start there with the elephant in the room. What is it about cryptocurrencies that makes them such a unique challenge for investors? I mean, you see this massive mainstream growth, right? But they come with this really pronounced volatility. We talk about heavy tails, basically. Extreme price swings are way more common than in traditional stock markets. And then you've got these frequent regime shifts. It's almost like the market just suddenly decides to play by completely different rules, without any warning. And because of all that, the traditional rules like buy and hold strategies that might work okay when markets are calm, they really fall apart in these kinds of settings. High frequency, high variance. They simply can't keep up. It's like trying to navigate whitewater rapids in a little rowboat meant for a calm lake.
That's a perfect analogy, actually. These market characteristics, they fundamentally complicate how you even think about building and managing a portfolio. You desperately need techniques that are flexible, that can adapt, almost instantly. You just can't rely on these old assumptions of constant risk or stable correlations. Because in crypto, those assumptions get shattered, like daily.
Okay, so if the traditional methods are hitting a wall, what's proving more effective? What are these innovative approaches? This is where the concept of multi-agent systems, or MAS, comes in. It's fascinating. This study uses MAS as the sort of modular way to automate the entire investment pipeline. So imagine you have specialized AI agents, right? Each one designed for a specific task. And they all work together collaboratively, ingesting data, cleaning it, analyzing it, building the portfolios, and then finally reporting the results. And the specific platform they used here is called CrewAI, which is a great example of this collaborative architecture. It lets these different agents interact, but in a modular way, across all the distinct stages of the process. It's almost like a highly efficient human team.
Exactly. And what's really crucial to understand about these agents is their design. It's very deliberate. Each agent gets programmed with a very specific goal, a clear objective. They communicate using structured prompts. Think of them like clear, precise memos for each task. And they work with pre-specified tools. So this whole design, it ensures the solution is scalable, it's auditable, super important, and it's incredibly flexible. It's not just some opaque black box churning out decisions.
Right, the auditability is key. Let's dig into the study's blueprint then, the nitty-gritty. What data did they use? Well, they looked at daily closing prices for the 10 largest cryptocurrencies by market cap. And the period was pretty significant. August 20, 2020, all the way to March 13, 2025. This included the big ones, Bitcoin, BTC, Ethereum, ETH, but also others like Binance Coin, BNB, Solana SOL, Ripple XRP, Cardano ADA, Dogecoin DOGE, Avalanche AVX, Polkadot DOT, and even Shiba Inu SHE. Now here's where it gets really interesting, and it really highlights the analytical challenge here. You look at Bitcoin, its average price in the data set was over, USD 45,000, but then you have tokens like Shiba Inu trading 4 orders of magnitude lower. We're talking fractions of a cent. Yet, and this is the kicker that shows similar relative volatility, similar dispersion. That's a huge hurdle for any traditional model. How do you handle that massive difference in scale but similar relative risk?
Yeah, it's a major challenge. And to manage that complexity, the multi-agent system needs a really comprehensive set of tools, foundational tools. Think of them as specialized instruments, right, for every part of the data lifecycle. You've got tools for loading the data, cleaning it up, splitting it into training and testing sets, standard practice, but automated here. And crucially, tools for performance analysis. Calculate things like annualized return, volatility, the Sharpe ratio, which, measures risk-adjusted returns, and also the Sortino ratio, which is a neat variation of Sharpe, actually. It specifically focuses on downside risk, the bad volatility, not just all volatility. Plus, they have optimizers for both static and rolling portfolio management, and even tools to benchmark against, say, the S&P 500. It's all designed for robust, reliable automation. And these tools, they underpin the whole system. There are 8 collaborative agents involved, and they're organized into 2 operational crews, Crew A and Crew B. They share the same basic structure, the same tools, but as we're about to see, their optimization logic, how they decide on the portfolio weights, is fundamentally different.
Right. And that difference in logic is exactly what the study is designed to test. It's a direct comparison of these two strategies implemented within this identical MAS framework. So first up, Crew A. This is the static portfolio analysis. Think of this one as the benchmark, kind of like a traditional set it and forget it strategy. It starts simple, evaluating an equally weighted portfolio, just dividing the money equally across all 10 cryptos. Then it does a single mean variance optimization using the training data, the goal. Determine fixed portfolio weights that maximize the Sharpe ratio while minimizing volatility. And they have constraints like no short selling, and you have to be fully invested.
Exactly. And the defining feature of Crew A is that there's no rebalancing allowed. Those optimized weights it calculates, they remain constant, fixed, throughout the entire investment horizon, both during the training period and when it gets tested on the new unseen data. It's strictly a one-and-done allocation.
Okay, static approach, Crew A. Then we have Crew B, the dynamic rolling optimization. And this is where that adaptive nature really comes into play. Instead of that single one-time calculation, Crew B does what's called a rolling window optimization. What does that mean? Well, every 30 days, it takes the most recent 30-day chunk of historical data, and it uses that to recompute and update the optimal portfolio weights. Again, always aiming to maximize that Sharpe ratio based on the latest info.
Yeah, and this approach, it genuinely mirrors the reality of adaptive asset management, right? Real investors constantly revise their allocations based on what the market's doing now. And it seems particularly well suited to the crypto environment. We talked about the volatility, the regime shifts. This constant recalculation lets the system capture those time-varying dynamics. It can respond much faster to sudden spikes in volatility or shifts in market sentiment. It's truly responsive, always looking at the latest picture and adjusting its move.
So just to nail down that core difference again, Crew A does one optimization, sets its weights, and that's it, sticks to them. Crew B, though, is continuously adapting, recalculating every single month based on the very latest market data. It really is like the difference between using a static paper map versus a real-time GPS for navigation. Okay, the moment of truth then. The results. How did these two crews actually perform? We're looking at those key metrics: annualized return, volatility, Sharpe ratio, Sortino ratio, maximum drawdown. And crucially, we need to see how they did both in sample, on the data they trained on, and out of sample, on the fresh data they'd never seen before. So what do the numbers tell us? Does adaptability win out?
Well, the numbers, they paint a pretty clear picture. Yes, adaptability seems to win out quite significantly here. Now, Crew A, the static one, it did show some improvement over just a simple equal-weighted approach, that's something. But its performance really paled in comparison to Crew B, the dynamic one. And what's fascinating, I think, is seeing how much that dynamic rebalancing helped. It let the system respond effectively to those market shifts, constantly tweaking the allocations based on the most recent data. Let's look at the Sharpe ratio, for example, that key measure of risk-adjusted return. In sample, on the training data, Crew B hit an impressive 1.00, Crew A was lower, at 0.83, both better than equal weights, which was around 0.53. But the real story, as always, is out of sample. On the unseen test data, here, Crew A's static allocation, well, it became pretty suboptimal, and Sharpe ratio dropped quite a bit, down to 0.69. Crew B, however, it maintained a much stronger Sharpe ratio of 0.72 out of sample. That shows much better generalization. It held up way better when faced with real-world unpredictable market moves. That's a big difference. And it wasn't just about getting higher returns either.
It was also about managing risk better, generally speaking. Crew B consistently showed lower volatility than Crew A across both the training and the test sets. Out of sample, for instance, Crew B's volatility was around 11% compared to Crew A's 13%. The equal weight portfolio was even higher, at 15%. Now, its maximum drawdown, the biggest P to trough drop, was actually slightly higher for Crew B out of sample sometimes, around NACS 18% versus NACS 18% for Crew A and NACS 20% for equal weights, which might reflect that at certain points it took on more exposure to potentially higher return but also higher risk assets. But overall, the risk-adjusted performance measured by Sharpe was demonstrably superior for Crew B. It really underscores how being nimble, being adaptive, truly seems to pay off in the crypto space.
So this is really interesting. What does it mean for the broader world of finance then? Because this study isn't just about crypto trading strategies, right? It's also highlighting the advantages of using this multi-agent system architecture itself. What are those game-changing advantages?
Exactly, that's a great point. The study really demonstrates 3 tangible advantages that go way beyond just the trading performance numbers. First, there's modularity.
Each agent, remember, has its own job, so each one can be upgraded independently. Maybe you find a new data source or develop a better analysis technique, a new heuristic. You can just update that one agent without having to rewrite the entire system. It massively enhances adaptability. It's like updating just one app on your phone instead of having to replace the whole phone every time something improves. Second, and this is huge, auditability. We touched on this. You have agents like the pre-flight checker and the final report agent, whose whole job is to log every intermediate step, every calculation, every piece of data used. This creates this transparent, verifiable trail that supervisors, regulators, anyone can inspect. This directly tackles that big black box criticism you always hear about financial machine learning. Imagine a big pension fund trying to explain an AI's decision to its beneficiaries if it's just a black box. It's a non-starter. The system offers genuine transparency,
which is absolutely vital for regulatory compliance, for fairness, explainability, and just building trust. And third, scalability. What if you want to add more cryptocurrencies to your portfolio, or track more benchmarks, or factor in different transaction cost models? With this MAS approach, it often just means spawning additional agents. You configure new agents for the new task. You don't necessarily have to go back and rewrite some massive monolithic piece of code that makes the system incredibly flexible and efficient to expand. So ultimately, what this MAS pipeline delivers is this really adaptive, high-performing workflow, but one that's also regulator-friendly. That makes it potentially suitable for serious academic research and for real-world institutional settings.
That combination is really powerful, adaptive and transparent. It does seem like a leap forward. But, okay, as with any study, especially groundbreaking ones, it's important we acknowledge the limitations too, right? No study is ever perfect.
Absolutely. And the researchers here were upfront about them. First, the universe size. They only looked at the top 10 cryptocurrencies by market cap. That's not the entire crypto market, obviously. There are thousands of tokens out there. Second, transaction costs. Things like brokerage fees, bid-ask spreads, they were ignored in the simulation. Now, for a highly active dynamic strategy like CRUB, which rebalances monthly, those costs could add up in the real world and potentially erode some of its performance edge.
Sure.
That's a fair point. Also, the window length for the rolling optimization, that 30-day window, was heuristic. They picked it, but maybe a different, like, say, 60 days or 15 days, might offer different results, different trade-offs between reacting quickly and having enough data. And finally, the risk metrics used. While Sharpe and Sortino are standard, they didn't model specific tail risk measures like conditional value risk or CVR. CVR tries to quantify the potential loss during extreme worst-case scenarios. So by not modeling it explicitly, the system might potentially underestimate the risk of those really big, rare market crashes.
Okay, good points to keep in mind. So wrapping this up, this deep dive into using multi-agent systems for crypto portfolios has, I think, clearly shown something important. Dynamic adaptive strategies seem to significantly outperform static ones in these highly volatile markets. It really makes a compelling case for flexibility in finance, especially in crypto.
I agree. And beyond just the performance numbers, the architecture itself, the multi-agent system, proved really effective. It automates the whole pipeline, yes, but it also makes it modular, transparent, and traceable. And those aspects, transparency, traceability, are absolutely critical for building trust and enabling adoption in the financial industry. It's not just about the returns.
Absolutely crucial. So let's leave you, our listener, with a final thought to maybe mull over. We've seen the benefits here of combining adaptive optimization with this modular agent design in crypto. So the question is, how might this whole paradigm, this way of thinking, extend beyond just crypto? Could it transform other complex data-driven areas in finance? What about completely different industries, maybe healthcare decision support or logistics optimization? And perhaps even more fundamentally, how do you see the balance shifting in the future between human expertise on one side and this kind of sophisticated AI autonomy on the other? Something to think about. We'll leave you with that until our next deep dive.